Okay, let's unpack this. Have you ever found yourself wondering what really drives the stock market? I mean, is it solely about quarterly earnings reports, the latest interest rate hike, or is it something far deeper, more fundamental, maybe something woven into the very fabric of how companies decide to grow or perhaps, sadly, shrink their workforce?
Yeah.
Today, we're diving into a connection that's been, well, kind of hiding in plain sight. The powerful link between the job market and the financial markets that could really reshape how you understand the entire economy.
It is fascinating, actually. And it's a significant development because for a very long time, the academic world's labor economics on one side and financial markets, specifically asset pricing on the other, they've operated almost independently.
Like shifts in the night almost.
Pretty much. Think of them as, two highly specialized scientists studying the same grand ecosystem, but rarely, if ever, actually sharing their observations. Our deep dive today explores some really groundbreaking research that bravely bridges this divide. It shows how the subtle, sometimes lagged dynamics of hiring and firing are intimately linked with the stock market's crucial risk premiums.
Risk premiums. Okay.
Yeah, it's a connection that, until quite recently, has been largely overlooked. But it carries profound implications for understanding not just our economy, but also for maybe forecasting its future movements.
And our mission for you, our listener, is to help you truly grasp these previously hidden connections. We're going to delve into how concepts like time to build and time to plan terms from the labor market don't just affect, say, your personal job prospects or the wider unemployment rate, but actually possess significant power to forecast where stock returns might be headed. So get ready for some genuine aha moments that might challenge your assumptions and change how you view the dynamic interplay between the world of work and the world of finance. To guide us through this intricate landscape, we're drawing our insights from a really key study. It was published in the highly respected Journal of Financial Economics titled, "Do Time-Varying Risk Premiums Explain Labor Market Performance?" The authors are Long Shen and Lu Zhang, and trust me, it's packed with surprising facts and powerful implications.
It's not just theory, it's rigorous empirical analysis.
Exactly. Connecting these two seemingly disparate fields with data stretching back decades. Really solid stuff.
Okay, so historically, if you looked at labor economics, the focus has predominantly been on the micro and macro dynamics of employment, wages, unemployment, that sort of thing.
The nuts and bolts of the job market.
Precisely. Researchers in this field would build intricate models, really complex ones, to analyze how firms decide to hire, how they set wages, how they might let people go, and the resulting patterns in the workforce. But for a long time, many of these models made a rather simplifying yet critical assumption.
Which was?
That the discount rates firms used to value their future profits were constant.
Okay, so they assumed the value of future money, adjusted for risk, never changed.
Essentially, yes. They'd analyze labor decisions in a world where the future value of money, adjusted for risk, always looked the same. This meant they often didn't explicitly factor in how the perceived riskiness of those future profits might change over time, or how investors' appetites for risk might fluctuate, which, as we know, they do. A lot.
So if I'm picturing this correctly, it's like having two brilliant engineers trying to understand how a car works.
Oh.
One is meticulously studying the engine, the pistons, the fuel injection, the pure mechanics of power generation. The other is focused entirely on the suspension system, the tires, how it handles different road conditions, the dynamics of interaction with its environment.
It's a good analogy.
Both are crucial, right? But if they aren't talking, if they aren't integrating their findings, they're missing how the engine's power delivery impacts handling, or how rough roads might strain the engine. You'd think they'd have a lot to say to each other, given they're both looking at aspects of the same economic vehicle.
Precisely. That analogy captures it perfectly. On the other side of this academic divide, you had asset pricing. This is the field that studies how financial assets, stocks, bonds, you name it, are valued and how those valuations change. For decades, asset pricing research has been intensely focused on the predictability of stock returns. And a huge foundational part of this research centers on what we call time-varying risk premiums.
Okay, time-varying, meaning they change over time.
Exactly. And the crucial point is that many standard labor market models have largely ignored the impact of these changing risk premiums on how firms make decisions about their workforce. This, as this new research powerfully demonstrates, is a significant oversight. It has very real economic impact.
Okay, here's where it gets really interesting, and perhaps a bit abstract for some. What exactly are risk premiums, and why should we, as individuals trying to understand the economy or even just our own job prospects, care about them when thinking about jobs?
Hmm.
For many, risk premium sounds like something only a Wall Street quant would obsess over, not the average person tracking unemployment figures.
That's a great question because it's absolutely core here. A risk premium is essentially the extra return investors demand for taking on more risks.
Okay.
Let's break it down with a simple analogy. Imagine you have two options for your savings. Option A is a perfectly safe, government-backed bond. You know exactly what return you'll get, guaranteed, very low risk.
Right. Predictable.
Option B is investing in a cutting-edge tech startup. Now, this startup could revolutionize an industry and give you enormous returns.
Or it could go bust.
Exactly. Or it could go bust and you lose everything. High risk, high potential reward. To convince you to choose option B, the risky startup, you'd naturally demand a higher expected return than what option A offers.
Makes sense. I want to be paid for taking that chance.
Precisely. That additional expected return you demand for taking on the uncertainty of the startup that is your risk premium.
Okay, got it.
Now scale that up to the entire stock market. Investors, in aggregate, demand a certain risk premium to hold a broad portfolio of stocks instead of safer assets like government bonds. And modern asset pricing research has powerfully demonstrated that these expected aggregate risk premiums are time-varying. They aren't static.
They fluctuate.
They fluctuate. They change over time, often based on overall market sentiment, prevailing economic conditions, the perceived level of uncertainty about the future. Lots of factors. For instance, in times of economic stability and optimism, investors might demand a smaller risk premium because they perceive less danger. Things feel safe.
Lower guard, lower demands.
Right. But during periods of high uncertainty or recession fears, that demand for extra compensation for risk shoots up significantly. And this variation isn't just some minor detail in financial models. It explains a large fraction of the change in a company's fundamental cost of capital. It's not just about interest rates.
Ah, the cost of capital. So how expensive it is for a company to raise money.
Exactly. And this is where the two worlds collide. When a firm's cost of capital changes because investors are demanding a higher or lower risk premium for the firm's stock, it directly impacts all its decisions on investment. If it costs more for a company to raise money to finance future projects, if its future profits are discounted more heavily because of higher risk.
Then maybe building that new factory or even hiring those new people.
Exactly. Even hiring new employees who won't be immediately productive becomes a more expensive proposition from the firm's perspective. It impacts everything from building a new factory to expanding a sales team. This deeply rooted, yet previously underappreciated linkage is precisely what the Chen and Zhang study is designed to explore and quantify.
So the big overarching question this deep dive unpacks, the one that acts as our compass today, is, do these time-varying risk premiums actually explain how the labor market performs? Does the financial pulse of the economy, that changing demand for risk compensation, have a direct, measurable influence on the very heartbeat of the job market? Is this the bridge between Wall Street and Main Street that maybe we haven't paid enough attention to?
That's exactly the question. And the answer, as we'll see, seems to be a pretty resounding yes. Okay, so to really connect these two worlds and understand the mechanisms at play, the study starts with a widely accepted fundamental framework in labor economics. It's called the search and matching model.
Right, pioneered by Nobel laureates like Pissarides and Mortensen.
Exactly. This model describes the dynamic, often messy, process of how firms and workers find each other in the real world. It's not instantaneous. It involves firms posting job vacancies, basically advertising their need for talent and workers actively searching for those jobs. Eventually, after a period of effort and sometimes luck, this process leads to successful matches or, new hires.
Ah, yes, the search and matching model. I was thinking of it like dating, but for jobs.
Huh. That's actually a pretty good way to think about it.
There's a search process on both sides, companies looking for the right fit, individuals looking for the right opportunity. Some matching happens, but it's certainly not always instantaneous. You don't just snap your fingers and have the perfect employee magically appear at their desk.
Definitely not.
Just like you don't instantly find your soulmate just by wishing for them. There are costs, time, and significant effort involved on both sides to make a connection. It's a market, but one with a lot of, well, friction.
Exactly right. And it's precisely within this framework, this messiness of the real world, that the study introduces two critical frictions that make the labor market far from instantaneous or perfectly efficient. The first of these is what economists call time to build.
Time to build. Okay.
This friction means that hiring a worker in the current period doesn't immediately translate to a productive employee contributing to a firm's output and profits. There's an inherent lag. For example, if a company makes a hiring decision at time 2, that new recruit might only become a fully productive contributing worker at time fee +1 or maybe even later +2 feet.
So there's a ramp-up time.
Exactly. This delay could be due to a variety of real-world factors: the necessary training and onboarding processes, the time it takes for a new team member to fully integrate into company culture and processes, or even the time needed to acquire specific tools or software they'll use. It takes time to build a productive employee. Now, let's really zoom in on the impact of this time to build friction, because it's crucial for understanding the sign flip pattern we'll discuss later. Imagine there's a significant positive shift in the financial markets specifically, a drop in the discount rate. Remember, a drop in the discount rate means that future earnings become more valuable in today's money. Investors require less compensation for future risks.
Right. Future profits look better now.
Exactly. It's like finding out that the prize you're expecting next year is actually worth substantially more than you thought right now. For a company, this immediately increases the perceived value or marginal benefit of hiring. New employees who generate future profits suddenly look like a much better investment. So the firm will immediately decide to hire more workers due to this positive financial signal. They'll start posting more vacancies, ramp up recruiting.
Makes sense. The economics look good.
However, because of time to build, those new hires aren't productive immediately. They need training, onboarding, time to get up to speed. So in the very short run, say the next quarter or two, while the company is investing in these new hires, spending money on recruitment, training, initial salaries, the overall productive workforce might not show a big jump.
Or it could even dip slightly if resources are diverted.
Potentially, or it might just appear stagnant. Resources are being diverted to the hiring process itself. This leads to a theoretical prediction: a short-run negative correlation between that initial positive financial signal, the drop in the discount rate, and actual employment growth.
So it's like planting a garden. You decide in spring you want a flourishing garden in summer because the weather forecast looks great for growing.
Okay, yeah.
You buy seeds, prepare the soil, you're investing time and money. But for a while, you just see soil, maybe even a bit of dirt being moved around, certainly no lush garden yet. That initial soil-moving phase, where you're putting in the work without seeing the immediate green shoots, that's your short-run negative or flat correlation.
That's a perfect analogy, exactly. You're investing, but the payoff isn't immediate. And then in the long run, once those seeds sprout, once those new hires are fully integrated and productive, then you see a strong positive correlation between that initial discount rate drop and the eventual robust increase in employment.
A garden blooms.
The garden blooms. So you see this dynamic sign flip pattern. Negative or flat in the short run, powerfully positive in the long run. And the length of this time to build friction is what dictates when that sign flip occurs in the data. Now, it's really important to distinguish this from the hiring rate itself.
Okay, the rate of new hires versus the total employment level.
Right. For the hiring rate, meaning the actual rate at which firms are taking on new employees, time to build alone predicts only a positive relationship with the discount rate, without any sign flipping at longer horizons.
Why the difference?
Because when the discount rate drops and future profits look more valuable, the firm immediately decides to hire more. The decision and the action of bringing people on board is immediate, even if those hires won't become productive until later. So the actual number of new hires generally moves in the same direction as the financial signal right from the start. The hiring rate goes up.
Okay, that distinction is key.
Very key. Now, the second friction the study introduces is time to plan. This is distinct from, but often related to, time to build. It refers to the time lags that occur between a firm's decision to undertake a major project that requires new staff and the actual expenditure on hiring those staff.
So this is more about the upfront strategic planning.
Exactly. Think of it as the strategic and logistical lead time. For example, a company might decide in January to expand its operations and hire 100 new engineers. That's the decision. But before they can even start interviewing, they need to budget for the expansion, get approvals from various departments, maybe secure funding, draft new job descriptions, set up recruitment campaigns, allocate office space.
The whole bureaucratic process.
It can be. This whole planning phase can take months before they actually start spending money on recruiting or bringing new people in. It's like planning a major construction project before breaking ground. There are several steps and delays before the actual building even begins, let alone becomes inhabitable.
Got it. Planning takes time.
Let's consider the combined impact of these two frictions. This gets a bit more complex, but it's important. If you have a scenario with, say, 1 period time to build, along with 1 period time to plan, the dynamics become even more layered.
Huh?
A discount rate drop at the beginning of period 2 would still lead to higher stock prices immediately, making future investments look more attractive. That part's the same. However, because of the planning lag, the time to plan, the actual hiring doesn't rise until period T+1. It remains constant in period 2 while the firm is still in the planning phase.
So the hiring rate itself is delayed now?
Exactly. Then, due to the time to build friction, the increase in the actual productive employment stock only shows up at the beginning of T+2 up. This combined friction implies that a discount rate drop would lead to a theoretical prediction of short-run negative and long-run positive correlations for both employment growth and, crucially, the hiring rate.
So if we see the sign flip in the hiring rate,
Yeah.
that's the smoking gun for time to plan being important.
Precisely. Observing whether that sign flip occurs for the hiring rate is key to distinguishing if time to plan is a significant factor at play, not just time to build.
This raises an important question, though. What if there were no costs involved in this search and matching process? What if finding and hiring a new employee was as simple as flipping a switch, like in some perfect theoretical model?
That's a crucial counterfactual to consider, and the study addresses it directly. It shows that without these costs, meaning if search and matching costs were zero, hiring would be perfectly elastic to changes in the discount rate.
Perfectly elastic, meaning?
Meaning in such a hypothetical, fictionless scenario, a tiny change in the discount rate would lead to an infinitely large, instantaneous hiring rate. Firms could instantaneously hire as many perfectly productive workers as they needed with no delay or expense.
So in a frictionless world, hiring would be instantaneous and infinite. That's definitely not our world. We see firms grappling with talent shortages, painstakingly long recruitment cycles, the very real costs of bringing someone on board, training, advertising.
Exactly. And this highlights why search and matching costs are not just theoretical constructs. They are absolutely crucial for any of these linkages between stock returns and labor market variables to exist in a meaningful way. Without them, there's no relationship to study, the model simply collapses, and the insights we're discussing wouldn't hold in any practical sense. It fundamentally means that the costs, the delays, the inefficiencies inherent in the real labor market are precisely what create these connections, what make these financial signals observable and predictable in the job numbers. They are the gears that transmit the financial signals into real economic activity.
The grit in the system is actually what makes it work, in a way.
In terms of creating these observable links, yes, it's what makes the relationship non-trivial. Okay, so to test these compelling theoretical predictions and see if these frictions actually manifest in the real economy, the study utilized a really comprehensive range of quarterly data.
This is where the rubber meets the road.
Absolutely. This involved extensive statistics from the U.S. Bureau of Labor Statistics, the Census Bureau, and various financial sources spanning a significant period from 1952 all the way to 2009. This long data set is absolutely essential for identifying robust, long-run patterns and ensuring that the relationships observed aren't just, short-term blips or anomalies.
Oh, right. You need that long view.
Definitely. For labor market variables, the researchers looked at several key indicators. First, payroll growth, specifically the growth rate of total non-farm payrolls, which gives us that broad, aggregate view of overall employment across the U.S. economy.
The headline number we often hear.
Pretty much. Second, they examined the net hiring rate. That's calculated as gross hiring minus separation rates. It gives a more dynamic measure of how quickly the workforce is expanding or contracting, the churn.
More about the flow, less about the stock.
Good way to put it. And third, for a more specific, granular sector view, they analyzed the net job creation rate in manufacturing. They recognized that different industries might operate with different labor market dynamics, different frictions.
Makes sense. Manufacturing might be different from services, for example.
Exactly. On the financial side, they employed several established proxies for aggregate risk premiums. These are variables that academic research has consistently shown predict market excess returns.
So they signal how much extra return investors are demanding for taking on stock market risk.
Correct. These proxies included the dividend yield, higher yield, sometimes signals lower expected future growth. They also use the log consumption to wealth ratio, CAY, a more sophisticated measure developed by Lettow and Ludvigsen. It looks at how much households are spending relative to their total assets. High CIY can signal households feel less wealthy, maybe anticipating downturns.
Okay.
Then the relative treasury bill rate, TB, short-term rates versus their history. The term premium, TRM, the extra yield on long-term bonds over short-term ones, often reflecting uncertainty. And finally, the default premium, DEF, the spread between risky corporate bonds and safer government bonds, a gauge of credit risk.
So a whole basket of financial indicators.
Right. By using a composite of these diverse indicators, they aimed to capture the multifaceted overall sentiment and demand for risk in the broader financial market, not just relying on one signal.
Okay, so they're essentially combining the stock market's most reliable crystal balls, if you will, to peer into the future of the job market. This is where it gets really concrete, seeing how those theoretical frictions we just discussed, time to build and time to plan, actually play out in real hard economic data.
Precisely. It's no longer just an idea on a blackboard. It's being tested with decades of history. Let's delve into their first major finding. Finding 1. Forecasting aggregate payroll growth. Strong evidence of time to build. The research reveals a clear, consistent, and frankly quite striking pattern when they looked at how these financial risk premiums forecast aggregate payroll growth.
Okay, what did they find?
They found that high values of their composite risk premium, which signals a period where investors are demanding significantly higher returns for taking on market risk, so maybe a nervous market,
Right, higher perceived risk.
predict low payroll growth in the immediate short run, specifically within the next 2 quarters.
Okay, so high risk premium, low job growth soon. That feels intuitive.
It does initially, but then here's the crucial part, the twist. Those same high-risk premiums surprisingly predict high payroll growth in the long run, from 8 quarters onward.
Whoa, okay, so a sign flip pattern emerges. Negative first, then positive later. This is exactly what you described with the time to build concept, right? Like waiting for those garden seeds to sprout.
Exactly. This dynamic sign switching negative in the short run, positive in the long run, is the clear, unambiguous signature of either a 2-period time to build or a combination of 1-period time to build and 1-period time to plan at work within the aggregate employment data.
And the initial delay, the negative part, lasts about 2 quarters.
That's what the aggregate data suggests, yes. After that initial lag, the investment in hiring, which was prompted by a lower cost of capital associated with that eventual fall in risk premium that often follows a spike, starts to pay off with increased payrolls later on. To give you a concrete example from the study's actual results, the statistical correlations between the 1 quarter ahead expected risk premiums and cumulative payroll growth were significantly negative in the very first quarter.
Okay.
They then became very close to 0 in the second quarter, indicating the trough of that short-run effect.
Bottoming out.
Right. And then, strikingly, they turned significantly positive and remained so in all subsequent horizons measured 3rd quarter, 4th, all the way to 8 quarters out. This pattern precisely matches the theoretical prediction we laid out for time to build. It shows the economic impact of financial signals unfolding over a predictable time horizon.
And this isn't just reaffirming what we already knew from other traditional economic indicators, right?
Yeah.
Like GDP growth or something. Are these financial risk premiums actually adding new information?
Absolutely, and this is where the research truly shines. It's a critical point. The study explicitly shows that these risk premium proxies don't just echo what we already know from traditional macroeconomic controls, things like lagged payroll growth itself, GDP growth, or consumer confidence. They add substantial incremental predictive power for future payroll growth, particularly at those crucial longer horizons.
How much power are we talking?
Well, for example, at the 8-quarter horizon looking 2 years into the future, adding these financial risk premium proxies increased the adjusted R-squared from a modest 5% when using only macro controls to a remarkable 33%.
Wow, that's a huge leap. From 5% explanatory power to 33%.
Exactly. To put that in perspective for you, an R-squared of 5% means those traditional factors explain only 5% of the variation in future payroll growth 2 years out. Kind of weak, but jump to 33%, and suddenly these financial signals are explaining nearly a third of that variation.
That really highlights the previously ignored, yet incredibly valuable information these financial variables carry for real economic activity, like jobs. It's like finding a whole new dimension to economic forecasting, a missing piece.
Indeed, it means that the financial market's collective assessment of future risk is not just an abstract concept, it's a powerful leading indicator for the labor market, especially in the medium to long term. They also looked at a related labor market variable, the growth rate of average weekly hours worked by employees.
Ah, so how much existing workers are working?
Right. Interestingly, unlike payroll growth, the growth rate of average weekly hours does not show this dynamic sign switching pattern.
Really? Why not?
Well, this difference is incredibly insightful. It suggests that adjusting weekly hours utilizing existing workers more or less intensively is a relatively smoother, faster, and less costly process for firms. They can ramp up or cut back hours without the significant frictions of hiring or firing. It's an easier lever to pull.
More flexible.
Much more flexible. In stark contrast, adjusting total payrolls, which means the costly and time-consuming process of bringing on new employees or laying off existing ones, is much more sluggish. And it does exhibit these pronounced time-to-build frictions. The data clearly differentiates the two. Now, let's move to finding two: forecasting net hiring rates, distinguishing time to plan. Here, the study's ability to differentiate between these two distinct frictions, time to build and time to plan, becomes very clear and gives us a more nuanced understanding.
Okay, focusing on the hiring rate now.
Yes, when they looked at the overall economy's aggregate net hiring rate, remember, gross hires minus separations across all sectors, the evidence does not support the existence of significant time to plan at the aggregate level.
No time to plan evidence in the aggregate. What did they see instead?
Instead, high aggregate risk premiums consistently forecast high net hiring rates across all horizons, from one quarter all the way out to 16 quarters. There's no sign switching pattern whatsoever for the aggregate net hiring rate.
Huh. So high risk premium predicts high hiring rate. That seems odd too.
It does seem counterintuitive at first glance, but remember the distinction. A high-risk premium might mean the cost of capital is high now, potentially discouraging long-term investment, hence the negative short-run payroll growth. But the hiring rate itself might be high if firms are perhaps replacing workers who leave separations or making short-term adjustments. The key is the lack of a sign flip.
Right. So connecting this back to our theoretical discussion, the lack of a sign flip for the hiring rate is crucial. It implies that the sign flip pattern we did see for aggregate payroll growth must be driven predominantly by two-period time to build.
Exactly.
Because if time to plan were a dominant factor at the aggregate level, we would have expected to see a similar sign flip for the hiring rate itself because the decision to hire would have been delayed.
Precisely. So this helps us pinpoint which specific friction is most at play at the aggregate level. It rules out significant aggregate time to plan.
Okay, that's a key piece of evidence.
It is. However, a different and equally illuminating story emerges when the focus shifts to a more specific sector: the net job creation rate in manufacturing firms.
Drilling down into manufacturing.
Yes. And here, in stark contrast to the aggregate data, the study does find strong and compelling evidence of time to plan within manufacturing.
Really? How so?
Here, high-risk premiums actually forecast low net job creation rates in manufacturing in the short run specifically, at the one-quarter horizon.
Okay, negative relationship, short term.
But then, precisely consistent with the predictions for time to plan, those same high-risk premiums predict high net job creation rates in the long run from 4 and 8 quarters onward.
So the sign flip pattern we specifically expected for time to plan, that initial delay in hiring decisions due to planning, shows up clearly in manufacturing.
Yeah, absolutely does.
This suggests that the planning phase for hiring lasts for about, 2 quarters or so in that particular sector?
That's what the timing suggests, yes.
Mm-hmm.
It implies a tangible lead time for manufacturing businesses, a real-world lag between a firm deciding to act on a major expansion and actually spending money on those new hires.
That's fascinating. Why manufacturing, though? Why would it be different from the broader aggregate economy in this regard?
That's a great question the study provokes us to consider. It could be due to several factors. Manufacturing processes are often more capital-intensive. Expansions frequently require longer lead times for significant capital investment, ordering new machinery, maybe constructing new facilities.
Right, big physical investments first.
Before new workers are even needed or brought on board, so the planning for the people follows the planning for the capital. There might also be more structured, perhaps more bureaucratic, decision-making processes around workforce expansion in larger manufacturing firms compared to, say, smaller service firms.
More layers of approval, longer budget cycles, maybe?
Could be. Or it could relate to the specialized training requirements often found in manufacturing. New hires might need extensive, specific skills development, which naturally introduces planning lags before the training can even begin, let alone be completed. This sector-specific finding powerfully highlights the nuance in how these labor market frictions manifest across different parts of the economy. It really shows that one size does not fit all when modeling the labor market.
Different sectors, different timelines, different frictions. Makes sense.
Exactly.
Okay, we've spent this deep dive so far exploring how financial data, specifically risk premiums, can act as a powerful forecasting tool for jobs. Fascinating stuff. Now let's completely flip the script. Can labor market performance, the very pulse of the job market, tell us anything meaningful about future stock returns?
The other side of the coin.
Exactly. This would be incredibly powerful if it works both ways, right? Creating a truly interconnected predictive model of the economy.
It absolutely does work both ways, and the findings on this side of the equation are equally compelling and, for many, I think, quite surprising. Let's look at finding 3. Labor market variables predicting market excess returns.
All right.
First, considering aggregate payroll growth, that broad measure of job creation. The study found that lagged payroll growth, meaning payroll growth from previous quarters, does predict future market excess returns, and with a significant negative slope.
Negative slope? Wait, so high payroll growth predicts low future returns.
That's right.
That is genuinely fascinating and, for many of us, completely counterintuitive.
Sure.
We often assume a strong job market, people working, money flowing, consumer confidence high, that should automatically mean a soaring stock market, right? Good times with good stocks.
It feels like it should, doesn't it?
Yeah. So why would high payroll growth lead to lower future stock returns? That just doesn't compute easily.
It's a fantastic point, and it really gets to the heart of how markets work, specifically the concept of counter-cyclical aggregate risk premium.
Countercyclical, meaning it moves against the economic cycle?
Precisely. Think of it like this. When the job market is robust, when payroll growth is strong and the economy is booming, investors generally feel pretty secure. They perceive less overall risk in the market.
Complacency sets in, maybe?
Or just lower perceived danger. And if there's less perceived risk, investors demand less of a risk premium for holding stocks. So while the economy might be humming along and things look good in the real world now, the future expected returns on those stocks actually go down because investors aren't demanding as much extra compensation for risk. The price might be high now, reflecting the good times, leaving less room for future gains.
Okay. You know, it's like when the weather's beautiful and the forecast is sunny for weeks, you don't pay as much for an umbrella because you don't feel you need it.
Exactly.
But when a storm's brewing and the economy looks shaky, you'll pay a lot more to protect yourself, meaning investors demand higher returns for holding risky assets then.
You've got it. The market is constantly pricing in these changing levels of perceived risk. High current growth often means low perceived risk, which implies lower required future returns. And this effect, the study found, is particularly pronounced at business cycle frequencies. Its predictive power peaks around the 4-quarter horizon.
So looking about a year ahead.
Yes. And the comparative predictive power of payroll growth here is also incredibly notable. The study shows it dominates traditional financial predictors, like the default spread and the relative treasury bill rate in forecasting future market returns at these horizons.
Really? Better than those standard financial indicators.
At these business cycle frequencies, yes. While some other financial predictors, like the dividend yield or the term spread, might maximize their predictive power at much longer horizons, payroll growth's power peaks at these shorter, perhaps more actionable frequencies. Crucially, it also retains some significant predictive power even when controlling for the famously powerful log consumption to wealth ratio, CAY.
Even controlling for CAY? That's impressive. CAY is considered a very strong predictor.
It is. This tells us that payroll growth carries unique, valuable, and non-redundant information for market timing and understanding future market performance. It's a signal from the real economy that financial markets seem to incorporate, but maybe investors haven't fully utilized.
A signal no investor or economist should ignore then.
I would agree. A very similar pattern emerges when looking at the net job creation rate in manufacturing. This variable also strongly predicts market excess returns with negative slopes within 4 quarters.
So same story for manufacturing jobs. Strong creation now predicts lower returns later.
Exactly. A manufacturing sector that's aggressively creating jobs implies lower future stock market returns, following that same counter-cyclical logic we just discussed.
So a manufacturing boom, which we might typically cheer as unequivocally good news, could actually signal lower stock returns ahead. That's a truly counterintuitive insight for many of us who might think a strong industrial sector always translates directly to booming equities. It challenges our basic intuitions.
It does. It's a powerful reminder that good news for the real economy today, in terms of job creation, isn't always directly translatable into good news for future stock returns. The market is forward-looking and adjusts its risk expectations constantly.
Okay, but what about the aggregate net hiring rate? Did that predict returns?
Interestingly, no. When the study looked at the aggregate net hiring rate for the overall economy hires minus separations, it found no significant predictive power for future market excess returns.
So payroll growth predicts returns, manufacturing job creation predicts returns, but the overall hiring rate doesn't.
Correct. Even though the estimated slopes were mostly negative, they weren't statistically significant.
Why the difference there?
Well, this again underscores the unique roles and nuances of different labor market measures and the underlying frictions. The aggregate net hiring rate, unlike the broader aggregate payroll growth or the more specific manufacturing job creation, doesn't seem to capture the same robust predictive signals for future market risk. It could be because it's a measure that is perhaps too volatile, reflecting a lot of churn that doesn't necessarily signal the same thing about broad economic risk as sustained payroll growth does, or maybe aggregating hiring decisions across so many different sectors with varying frictions effectively cancels out its predictive signal for the broader market.
So choosing the right labor market variable matters a lot for financial forecasting.
It highlights that importance, absolutely.
Yeah.
You need to understand what each measure is actually capturing.
So, okay, let's pull this all together. What does this all mean for you, our listener? Whether you're tracking broad economic trends, managing investments, running a business, or just striving to be well-informed about the complex machinery of the economy, these insights aren't just academic curiosities, right? They seem to have profound real-world implications that can genuinely shift your perspective.
Absolutely. There are several key takeaways we really want you to walk away with today. First, it's clear that time-varying risk premiums are not just theoretical financial jargon. They are quantitatively important in forecasting employment growth.
We saw that big jump in R-squared.
Exactly. We've seen how they exhibit distinct short-run negative and long-run positive effects, creating that crucial sign flip pattern, particularly at the aggregate level. This fundamentally means that the financial market's collective assessment of risk truly precedes and influences the pace of hiring and job creation over time. It acts as a leading indicator for the real economy. Second, the study empirically distinguishes between different types of labor market frictions, specifically time to build versus time to plan.
And found they dominate in different areas.
Right. We found robust evidence that time to build appears to dominate in aggregate employment and overall hiring dynamics, reflecting those inherent lags in getting new hires productive. In contrast, time to plan is shown to be a significant and distinct factor in specific sectors like manufacturing, likely due to their capital intensity and structured planning processes. This detailed empirical understanding allows for much more precise modeling and forecasting. It recognizes that different sectors might operate with different lead times. Third, and this is a truly significant finding for investors and economists alike, labor market variables, especially aggregate payroll growth and manufacturing job creation, are powerful and unique predictors of future stock market excess returns.
And crucially, with that negative relationship.
Yes, the consistent finding of negative slopes indicates that crucial counter-cyclical relationship. A strong job market, characterized by high payroll growth today, often forecasts lower future stock returns. This happens because investors demand less of a risk premium in a perceived stable and booming economic environment. It really challenges simplistic notions of a direct, positive correlation between economic health and immediate market gains. It urges a much more nuanced understanding. And stepping back, this pioneering research is, at its heart, a powerful call for much deeper and more explicit integration between the fields of labor economics and asset pricing.
Bridging that divide we talked about at the start.
Exactly. Current leading models in labor economics often make simplifying assumptions like constant discount rates or using certain utility functions that lead to near-zero time invariant risk premiums. These assumptions, while maybe mathematically convenient, demonstrably prevent these models from explaining the crucial empirical linkages we've discussed today. They essentially miss out on a significant driver.
So they're missing a big piece of the puzzle by ignoring how financial risk perceptions influence hiring.
That's the argument. They miss a quantitatively important driver of real economic activity and its connection to financial markets.
It sounds like the entire field of economics has some serious homework to do, bringing these previously separate fields into a more unified, holistic view of the economy. It's about building a more complete picture, not just looking at isolated pieces, but understanding how they all fit and move together. It's an exciting prospect for future economic modeling, isn't it?
Absolutely. The findings strongly suggest that by rigorously integrating time-varying risk premiums into labor market models, economists can develop far more accurate, robust, and predictive frameworks. Frameworks for understanding and forecasting labor market performance, and critically, its dynamic interaction with financial markets. This integration would lead to a more holistic, more realistic understanding of business cycles, firm investment behavior, even the broader health of the economy.
But what about the practical applications for businesses, investors, policymakers?
Oh, they're widespread. For businesses, understanding these inherent lags in hiring decisions, the time to build, the time to plan, and their deep connection to financial market risk signals, can profoundly inform capital allocation and workforce planning. For instance, anticipating when the market's cost of capital might impact hiring decisions based on risk premium signals can help firms strategically plan expansions or contractions, maybe avoiding costly mistakes or missed opportunities.
Being more proactive based on financial signals.
Potentially. For investors, incorporating these labor market indicators, payroll growth, manufacturing job creation alongside traditional financial proxies, can offer a more robust and nuanced forecast of future stock returns. Leveraging these often countercyclical insights might potentially enhance investment strategies, maybe offering better timing signals.
Using job data to time the market, in a sense.
It adds another dimension to consider, certainly. And for policymakers, this research highlights the complex, interconnected nature of financial and labor policies. It emphasizes that decisions in one arena, say, monetary policy affecting risk premiums, will inevitably ripple into the other, the labor market, often with predictable delays that need to be accounted for. It shows that stable financial markets and healthy labor markets are not just goals in isolation, but deeply intertwined aspects of economic well-being. You can't really separate them.
You really can't. This deep dive really makes you think about how our economy is truly a living, breathing, incredibly interconnected system, where every decision from a firm's strategic hiring strategy, months in the planning, to an investor's minute-by-minute risk assessment in the market creates ripples that spread far beyond its immediate impact.
It really does.
So the next time you hear about the latest job numbers or the latest stock market forecasts, maybe take a moment. Consider those unseen threads that tie them together. And perhaps even how a company's past hiring spree, driven by low-risk premiums back then, might be subtly influencing your future investment returns, months or even years down the line. What stands out to you, thinking about all this, as the most surprising, perhaps even paradigm-shifting connection from today's deep dive, something for our listeners to really chew on?